Inventory valuation is a critical component of financial reporting for any company that manufactures or sells physical products. The value assigned to inventory directly impacts key financial metrics such as cost of goods sold, gross profit, and net income. As such, choosing an appropriate inventory costing method is an important decision that can have significant implications for a company's financial statements. Standard costing is one common approach to inventory valuation that has been widely used for decades. Under this method, companies assign predetermined costs to their products based on expected levels of materials, labor, and overhead expenses. These standard costs serve as a benchmark against which actual production costs are compared, with any differences recorded as variances. While standard costing can be an effective tool for cost control and performance measurement, it's important to understand how it differs from other inventory valuation methods and the potential impact on financial reporting. In this guide, we'll take a closer look at standard costing in the context of inventory valuation and compare it to two other popular methods, last in, first out, and first in, first out. How standard costing affects inventory value. Under a standard costing system, inventory is valued at the predetermined standard cost, regardless of the actual costs incurred during production. This means that the value of inventory on the balance sheet may not reflect the true economic cost of producing those goods. For example, let's say a company sets a standard cost of $10 per unit for a particular product, based on expected materials, labor, and overhead costs. If actual production costs come in higher at $12 per unit due to unexpected price increases or production inefficiencies, the company would record an unfavorable variance of $2 per unit. However, the value of the finished goods inventory would still be recorded at the standard cost of $10 per unit, even though it cost the company $12 to produce each unit. This means that the inventory value on the balance sheet would be understated, and the cost of goods sold would be understated when those products are eventually sold. Conversely, if actual production costs come in lower than the standard cost, the company would record a favorable variance. In this case, the inventory value would be overstated, and the cost of goods sold would be overstated when the products are sold. The impact of these variances on financial reporting can be significant, particularly for companies with large inventories or those operating in industries with volatile cost structures. Managers must be aware of how standard costing affects the accuracy and reliability of their financial statements and take steps to mitigate any potential distortions. Comparing standard costing to LIFO and FIFO. While standard costing is a widely used method for inventory valuation, it's not the only option available. Two other common approaches are LIFO and FIFO, each of which has its own advantages and disadvantages. Under the LIFO method, the most recently purchased or produced inventory is assumed to be sold first. This means that the cost of goods sold reflects the most recent cost incurred by the company, while the inventory value on the balance sheet reflects older, potentially lower costs. In contrast, the FIFO method assumes that the oldest inventory is sold first. This means that the cost of goods sold reflects the oldest costs incurred by the company, while the inventory value on the balance sheet reflects more recent, potentially higher costs. The choice between LIFO, FIFO, and standard costing can have significant implications for a company's financial statements. Here are a few key differences to consider. Inventory valuation. Under LIFO, inventory is valued at the most recent cost, while under FIFO, it's valued at the oldest costs. With standard costing, inventory is valued at the predetermined standard cost, regardless of actual costs incurred. Income taxes. In the US, LIFO is often used for tax purposes because it can result in a lower taxable income during periods of inflation. FIFO and standard costing do not offer this tax advantage. Use variance analysis for cost control. While variances can distort inventory values, they can also provide valuable insights into areas of inefficiency or waste in the production process. Use variance analysis as a tool for continuous improvement and cost control. Consider the impact on financial ratios. Be aware of how standard costing affects key financial ratios and communicate any impacts to stakeholders. This may involve providing additional disclosures or adjusting performance targets to reflect the chosen inventory valuation method.